Hello and welcome to my screencast. My name is Josh Gaddis, and today I'll be talking about the financial concept of bank reconciliations. We hear about bank reconciliations quite a lot in the financial world, but what is a bank reconciliation? Well, a way in which we'll be able to understand what exactly a bank reconciliation is through an example between a business and the bank. Let's take, for example, company XYZ. Within both two entities, we can see the different debit and credit transactions that occur and are recorded over a period of time. This is seen in a cash book, where company XYZ can see what they have maintained in their own accounting records, and also in bank statements, which is a statement of transactions that the bank produces at the end of each month on behalf of the business. Both statements should equal the same amount. However, most of the time this isn't the case. Thus, bank reconciliations are implemented. The reasons as to why these two statements may not add up include human error, as maybe the person recording the transaction might have misspelt an amount or even misread, which can be understandable as everyone can make a mistake. There can also be omissions, which are transactions that appear in the bank statement which the company decides not to record, as they may not know that they have received these incomes. This can include interest, fees from the bank, missing receipts, and bounce checks. Timing differences is also another factor, which is transactions recorded in both the bank statement and the cash book, but in different periods. These timing differences are usually either deposits in transit, which is a deposit made by the company but not yet cleared the bank as of the statement date, or it can be an outstanding check, which are checks that have been distributed by the company but not yet cleared the bank as of the statement date. The reason to why bank reconciliations are implemented is to identify all these errors so that we are able to understand all of the cash inflows and outflows of the business, thus making the bank reconciliation an essential and key cash control in the financial world to ensure that your company's books are neat, organized, and up to date to give a precise view to the cash flows and thus allow us to see the overall cash balance of the company. Thank you for listening.